Hello everyone and welcome to Structured Finance Conversations. My name is Paula Moreno, Head of Structured Finance for the Americas, and today I'm joined by Derek Miller, Head of North American Structured Credit at Fitch Ratings. Today we'll discuss 2025 issuance, performance trends, rating transitions, and what's next for the sector. So let's get started. Derek, let's start with issuance. How would you characterize 2025 issuance across structured credit, particularly U.S. CLO, new issuance, resets, and refis?
Well, the issuance volumes this year have been quite robust, similar to last year, where we saw a lot of transactions coming to market given the favorable spreads in terms of the liabilities for transactions. I would say year to date, we are about 10 to 20% higher, 10% higher on the new issue side, about 20% higher on the reset side relative to where we were year to date last year.
And how balanced is issuance between new issue versus resets, refis?
So in the new market space, we're seeing about 40% of transactions that are coming to market are new issue CLOs. That means new portfolios, new liabilities, and about 40% that are resets of existing transactions. And then that's followed on by about 20%, filled in by 20% that are refinancings of existing CLO liabilities.
And are you seeing any structural shifts in reinvestment periods or AAA subordination?
So in terms of the risks within the transactions, generally we're seeing a lot of the same trends for transactions. We are seeing similar credit enhancement levels across the board with transactions. We're seeing transactions come to market similar to what we've observed in the last 2 to 3 years, where there are some junior AAA tranches within structures. Additionally, you may find transaction structures carving out a junior BBB tranche as well to absorb losses ahead of other tranches.
And what's driving the pace? Is it liability spreads, loan supply, or manager risk appetite?
Well, I think there's a number of factors that are driving the issuance volumes. So I think the first one is you don't have issuance volumes without having stable performance and strong performance. So you see strong performance in terms of the CLO note liabilities, in terms of their ratings, and in terms of their market prices holding up. And so what's happened in the last 2 years, we've seen investors that had pulled back in terms of their investment in 2022 or 2023, coming into 2024 and 25, they've been more active in the space. So that's driving increasing demand for CLO notes as a lot of CLOs exit the reinvestment period and CLO notes amortize. And then another factor is that's driven CLO liability spreads tighter. Which then has driven loan prices higher and also driven spreads on loans tighter. And then that becomes a cycle where transactions that are out of their non-call period are incentivized to reset or refinance their liabilities to better proportion their cost of funding relative to where the loan market has reset.
I think this is the perfect segue for us to move from issuance to underlying credit performance. You briefly touched on it. We were previous question, but what has performance or what have we observed in the U.S. leveraged loan market that backs the CLOs?
Well, in the loan market, we've observed some level of defaults that are slightly elevated in terms of defaults this year. It's been about 5% year to date in the loan market. But we've seen a much smaller proportion of defaults actually within CLO portfolios. The average CLO portfolio that we rate within its reinvestment period has a default exposure of about 0.5%. And a big part of that is 2 elements. One is the active management within portfolio transactions by the CLO managers. And then a second piece of that is that a great proportion of defaults are occurring outside of bankruptcy. So they're distressed debt exchanges. The period of default is very short, and that impacts ultimately the recovery and the losses that come through to CLOs.
And where do you see default rates trending?
So right now we're forecasting for the remainder of the year default rates to be 5.5% to 6% in the leveraged loan space on a notional basis.
And any sector-specific concentrations, or is it more idiosyncratic?
In terms of sectors and where we expect to see a greater proportion of defaults, that's really driven by our corporate team's view of market concern loans across the board. They're looking at loans, the 1,700 to 1,700 issuers that issue loans that go into US BSL CLOs, and across those loans, they're commenting and indicating loans that are market concern loans, top tier, tier 2, and then other market concern loans. And from that list, they're doing a bottom-up analysis in terms of default forecast. But out of that list is where you'll find a higher proportion of issuers in the healthcare, higher proportion of issuers in the telecom and technology sectors as well. Those sectors end up representing, typically they're in the top 5 to 10 industries across CLOs.
And how do recoveries compare between bankruptcy processes and distressed debt exchanges?
Yeah, the bankruptcy, well, the default process is interesting in that, so whether an issuer files for bankruptcy or whether an issuer goes through restructuring through a distressed debt exchange or a liability management transaction, or even if they just have a missed payment that are outside of the terms of the conditions of the loan agreement, that's considered a default from our perspective. So all of those are defaults. So what about the recovery and how does that impact CLOs? We've seen a clear dispersion in terms of recoveries from issuers that have filed for bankruptcy. We've seen those recoveries end up trending lower and lower. If you look back to the last 18 months, we've seen straight line average recoveries on those senior secured loans be in the 50 to 55% range. If you look at the recoveries from an issuer that goes through a distressed debt exchange, the CLO may realize a recovery anywhere between 70 to 90%. If they hold on to the loan, it'll probably be closer to 90%.
Okay, so considering this backdrop, let's talk about CLO ratings and their performance. What has been the performance of Fitch's CLO ratings in 2025? And maybe just compare it, has there been any change when you look back, say, the past decade?
Yeah. So the performance in the last 12 months has been very strong in terms of rating stability. We've seen minimal, we haven't seen any real downgrade activity other than maybe at the single B level on a few tranches. We've seen general stability across the capital structure. In terms of outlooks, over 99% of the ratings that we have outstanding have stable outlooks. A few have positive outlooks, very few have negative outlooks. When you think about the rating changes that have occurred over the last decade within US CLOs, we've seen less than 1% of the portfolio experience negative rating actions, and that's across over 6,000 bonds that we've assigned and maintained ratings on.
And which factors are most predictive of transitions? Is it the CCC concentrations, the OC cushions, or manager performance?
Well, it's a combination of a lot of the key rating drivers that we look at, right? It's credit quality and then recovery once you go through that. But all of that is really driven by portfolio management decisions, right? And so you find that transactions that have performed most poorly tend to be transactions that continue to reset or refinance and have an exit the reinvestment period. And you may see the ability of the manager to trade limited or reduced. And then that's going to impact especially the more junior notes in the capital structure. What tends to happen after the end of the reinvestment period is you have single A or at least certainly double A and triple A tranches that tend to increase their rating stability as the CLO portfolio amortizes. The analysis that we're conducting to determine whether a rating needs to change on a CLO note is conducted on a weekly basis through updating our entire modeling process for all the thousands of bonds that we rate. And we actually disclose the level of cushions that we frame them as and term them as cushions of additional loss that the CLO tranches can absorb before being downgraded. And so we find, there's a very broad range, but I'll give you an example. At the median AAA CLO note that we rate, it could absorb another 7% of portfolio losses and still stay AAA. Now that compares as you go down the stack to maybe the median, triple B tranche could absorb, something like 3 to 4%.
Thank you, Derek. Let's turn to new developments. With the rise of private credit, beyond CLOs, we're seeing issuance pick up in areas such as feeder funds. And you recently released the criteria for feeder fund debt. Can you walk us through the key elements of this analysis?
Well, the key elements of that rating criteria are twofold. The first is a quantitative analysis where we're looking at the assets and the performance of those expected assets over time. And the second element is a qualitative one focused on the originator and the manager of the transaction. So in the quantitative analysis, if we have a credit view on the underlying assets in the form of a rating or a credit opinion, which is likely the case in corporate loans, private corporate loans, or infrastructure loans, we're going to utilize that in terms of determining our default expectation for the portfolio. And then when we're looking at other asset types, we're going to look at aggregation of cash flows based upon the expert view of sector specialists within Fitch. And we'll model those from a quantitative perspective for ultimate cash flows from the fund to the rated note feeder and the structural features of that feeder. Beyond that, on the qualitative side, we'll be looking at the originator and their platform, the historical performance of their funds, the historical management trends that they've actually undertaken within the existing funds, and then ultimately their strategy with respect to interest rate risk and management there, as well as management of FX risk as well.
Derek, you mentioned the types of, you said something of like different assets coming into the feeder funds. Can you give us sort of an idea of what you're seeing?
Yeah, so in the asset level, we've seen proposals where the fund holds predominantly private corporate direct lending loans. And in addition to that, we've seen portfolios backed by infrastructure loans as well. Beyond that, we've seen portfolios that could include one or a combination of asset-based loans. So that would be consumer loans for, could be autos, it could be, other types of loans to consumers in addition to residential loans. So, resi assets that could be in the form of the whole loans themselves. It could be in the form of a loan to the originator or in the form of CUSIPs, bond issuances from those sectors as well. And then in addition to that, we've seen issuance proposals where the fund holds primarily commercial real estate and commercial real estate loans as well.
Thank you, Derek. So to wrap up, let's look ahead. What should investors watch for in the second half of 2025 and into 2026 across your sector?
Well, there are a number of things that investors should be on the lookout for. So obviously one that could impact CLO transactions would be elevated levels of defaults. Elevated levels of defaults on underlying assets is going to mean that there's ultimately going to be some level of losses passed through on CLO portfolios. And then I think combined with that, looking at the recovery expectations. So that's combined with, do we continue to see the pattern of 20 to 30% of defaults in the loan portfolio being from bankruptcy, where the remainder of that is from a distressed debt exchange, leading to recoveries and losses that we've seen more historically, or do you see a shift there, a fundamental shift there? Beyond that, you're also looking to see whether there's some kind of prolonged recessionary trend, right? I mean, where we're at right now, that's not something that we're forecasting, but that could obviously be an impact to rating performance. And then I think, thirdly, when you look at different industries and different sectors, there could be impact in terms of government regulations or decisions that may impact specific sectors, and that could have a flow-through effect on CLO portfolios to the extent that managers aren't prepared to reposition their portfolios.
So what is your sector outlook?
Well, as I mentioned earlier, a majority or almost all of our CLO note ratings that we have outstanding have a stable or a positive outlook. We expect rating performance to remain stable or positive for tranches that are out of the reinvestment period. And so we expect our ratings to continue to perform, and especially at the investment grade level, see tremendous stability there in terms of the additional losses or portfolio deterioration that could occur, and those ratings remain at their current level.
Well, Derek, thank you very much for your insight. And thank you all for joining us. If you have any questions or would like to continue the discussion, please email sfconversations@fitchratings.com. We'll also include a QR code that links to this address. Thanks for watching.